Welcome to Simple Investing Secrets. In today's video, we'll review 9 of the best REIT stocks to buy and hold now for dividend growth. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Real estate investment trusts, or REITs, had a rough year, with total returns, price plus dividends, for the equity REIT sector beating those for the S&P 500 as a whole. But double-digit declines over the last year could set the stage for some of the best REITs to rally in 2023. Investment managers specializing in REIT stocks anticipate macroeconomic conditions will remain challenging in the new year due to high interest rates, inflation, and recession fears. Still, it's important to keep in mind that operating results are still good. As fears fade and capital markets stabilize, this will pave the way for a real recovery next year. If the Federal Reserve can keep inflation in check and keep the economy from going into a deep recession, REITs are likely to lead to good income growth next year. In this case, real estate investment trusts would be able to take advantage of the fact that there is more demand for space to rent than there is a new supply, which has been limited by sharply rising costs for materials and labor. This supply-demand imbalance will give REITs strong rental pricing power for many property types. Investment managers also think that the best REITs to buy in the coming year are those continuing to benefit from secular tailwinds. These include self-storage, apartment, alternative housing, cell tower and industrial space operators. Net lease REITs are also appealing because they have long-term leases that bring in steady cash flows no matter what the economy is doing. In light of this, let's examine the 9 best REIT stocks to buy right now in order to enjoy dividend growth through 2023. The names featured here all have strong defensive characteristics and exceptional pricing power. They are well prepared for rising interest rates thanks to their effective cost controls and balance sheet management. What's more, these are some of the best dividend stocks, with payouts that are well covered by FFO or funds from operations, a key REIT earnings metric. Many of these names have generated a decade or more of steady dividend growth, while others are prepping for big 2023 dividend hikes. Number 9. Sun Communities, ticker SUI. Market value, $18.1 billion. Dividend yield, 2.4%. Sun Communities is America's leading owner/operator of manufactured housing, RV parks, and marinas. SUI's existing portfolio is made up of 352 manufactured housing communities, 179 RV parks, and 131 marinas. Also, the REIT has a strong development pipeline with 9,000 sites for manufactured homes and 7,000 sites for RVs. Sun Communities' portfolio occupancy levels are 97.1% in North America and 91.7% in the UK, where it owns 55 RV holiday parks. SUI is on this list of the best REITs to buy in 2023 because it benefits from compelling supply-demand fundamentals for manufactured housing. Sun Communities received approximately 43,000 applications for sites in its housing communities this year. Manufactured housing is popular because it can provide 25% more space than a typical multifamily rental while costing 54% less per square foot. Approximately 9.5 million Americans plan to purchase an RV over the next 5 years, and there are only about 1 million RV sites available nationwide for an estimated 11 million RV owners. Accretive acquisitions helped the REIT deliver 28.4% core FFO per share gains during the September quarter and boost its full-year FFO guidance. SUI has produced 9.2% core FFO per share growth over the last 10 years, outpacing the major broad market and REIT indices by a wide margin. The dividend has increased by 5.5% annually on average over the last 5 years, and the payout, at 47% of FFO, is extremely low for a REIT. Number 8. Prologis, ticker PLD. Market value, $109.5 billion. Dividend yield, 2.6%. Not many REITs have attracted analyst upgrades recently, but Prologis is one of them. Scotiabank analyst Nick Yulico upgraded PLD to outperform from neutral, citing the company's compelling embedded rent growth, solid balance sheet, and dominant real estate platform. Prologis owns logistics real estate across the US, Europe and Asia. Roughly 2.5% of global GDP flows through its distribution centers. Its portfolio is made up of warehouses representing 1.2 billion square feet of space leased to over 6,300 customers and is valued at $188 billion. Its customers are major logistics players like UPS, and DHL and e-commerce merchants like Amazon.com and Walmart. In addition to its existing facilities, the REIT owns a development-ready land portfolio that could add another 227 million square feet of new leasing space. PLD is one of the best REITs to buy given its exceptional track record for creating value for investors. It does this in part through development activities and has generated over $11 billion in new value from $40 billion invested since 2001. Third-party facility management is another growth engine for the REIT. Earnings related to this business have risen 22% annually over the past 5 years. The company's core FFO per share and dividend growth have exceeded REIT peer levels in the S&P 500 over the last 3 to 5 years. What's more, PLD's A credit rating and $12.7 billion of new investment capacity should fuel steady future growth. Over the last 5 years, Prologis has increased dividends by 11.5% per year while keeping the payout at 56% of FFO. This points to an exceptionally secure and rising dividend. Number 7. Public Storage, ticker, PSA. Market value, $52.6 billion. Dividend yield, 2.7%. Self-storage is the REIT world's most recession-resistant segment. Other real estate suffered 25% to 67% net losses during the Great Recession, but the self-storage segment grew profits by 5%. Public Storage is the market leader in self-storage. The REIT has top market shares in 14 of the 15 largest U.S. markets and more than twice as many locations as its next largest competitor. It has interests in over 2,800 facilities and approximately 200 million square feet of rentable space and a presence in 40 U.S. states. Its top markets, Los Angeles, San Francisco, Miami, New York and Seattle contribute approximately 40% of revenues. The REIT has been aggressively building its franchise. Since 2019, Public Storage has expanded its portfolio by 23% and made over $7.4 billion of new investments. Profits have not taken a backseat to growth. PSA has been able to keep growing its operating margins, which have grown, thanks to digital projects and lower costs for payroll and utilities. As such, the company has emerged as the profit leader in the self-storage industry. The REIT's September quarter FFO per share rose 20.8% year over year, easily beating analysts' consensus estimates. Public Storage also raised its full-year FFO outlook. All of the company's major markets posted double-digit rent growth, with particular strength in the Los Angeles and Miami markets, which were up 22% and 25%, respectively. Public Storage has an A2 credit rating and one of the best balance sheets in the REIT industry. While dividend growth has been a lower priority than portfolio expansion and debt reduction, the REIT recently rewarded its investors with a $13.15 per share special dividend. Comments from management indicate plans to resume dividend growth in 2023 and beyond. Public Storage has plenty of dry powder to support dividend growth with operating cash flow exceeding $2.4 billion so far this year, total liquidity exceeding $1.0 billion and payout from FFO currently at 52%. Number 6. American Tower, ticker, AMT. Market value, $101.6 billion. Dividend yield, 2.9%. One of the best inflation hedges is a dividend rising faster than the Consumer Price Index, CPI. Cell Tower REIT American Tower has done just that. Since 2012, this REIT's dividends have grown by 20% each year, and analysts expect them to grow by 18% each year until 2025. AMT's dividend is also well covered, with its FFO payout ranging around 64%. Over the past decade, AMT has generated robust gains in revenues, up 14.2% annually, up 14.1% per year, and adjusted FFO per share, up 13.8% annually. American Tower has a portfolio of more than 223,000 cell tower sites spread out over 6 continents. This portfolio is big and spread out geographically. The company is a major beneficiary of 5G investments by major wireless carriers that lease space on the REIT's cell towers to build out their networks. Adding new tenants to current cell towers is extremely profitable for the company. Returns jump from 3% for 1 tenant per tower to 13% for 2 tenants and 24% for 3 tenants. Last year, AMT bought the data center REIT CoreSite, which made the company more competitive and allowed it to offer its tenants a more vertically integrated infrastructure that could support the next generation of 5G networks. Since buying CoreSite, American Tower has cut its debt by a lot and kept its balance sheet at an investment grade level. The company ended the September quarter with $2.1 billion of cash, $7 billion of total liquidity and floating interest rates reduced from 31% to 20% of debt. The adjusted FFO per share was down slightly due to tough comparisons to last year's September quarter, when the company received a large non-recurring advance payment from a customer. Number 5. Alexandria Real Estate Equities, ticker, AER. Market value, $24.7 billion. Dividend yield, 3.2%. Alexandria Real Estate is a life sciences REIT specializing in science, agricultural technology, and technology office space located in the innovation centers of Greater Boston, the San Francisco Bay Area, New York, San Diego, Seattle, and the Carolina Research Triangle. The REIT has more than 1,000 tenants, all of which are recession-proof. They include large pharmaceutical and biotech companies, academic and government labs, and companies that make life science devices. The REIT's life science properties are in high demand, as shown by the fact that 1.7 million square feet of new leases were signed in the September quarter, of which 87% were with existing tenants. ARE also posted the same property net income growth of 10.6%, which was the third highest quarter in the company's history. Alexandria Real Estate grew FFO per share by 9.2% during the September quarter, helped by new leasing activity, easily beating analysts' consensus estimates. The company also tightened its full-year FFO guidance at the upper end of the previous range. Alexandria Real Estate is certainly not the cheapest REIT out there, currently trading at 23 times forward-adjusted FFO. Still, AR's dividend payout from FFO looks ultra-safe at 56% and dividend growth is attractive at 6.6% annually over 5 years. Number 4. Essex Property Trust, ticker, ESS. Market value, $14.6 billion. Dividend yield, 4.0%. Shares of apartment REIT Essex Property Trust have taken a major beating this year, down nearly 40% year to date amid fears that a Silicon Valley employee exodus, not to mention massive tech layoffs, will hurt the REIT's primarily California coast and Seattle-centric portfolio. However, despite recent departures by some tech firms, the West Coast markets served by Essex Property Trust don't appear to be in jeopardy and continue to show above-average employment growth, higher than average household incomes and severely constrained housing supply. The REIT also keeps getting portfolio occupancy rates of 96% and steady double-digit revenue growth at the same properties. ESS owns 253 apartment complexes with a total of 62,000 apartments. These complexes are in 8 of the biggest West Coast markets. Since 2007, Essex Property Trust has been able to grow its core FFO per share by twice as much as the REIT industry average and grow its dividends by a lot more. This is because it focuses on profitable West Coast markets. Essex Property Trust September quarter core FFO per share rose 18.3%, and full-year FFO guidance looks for 15.9% growth at the midpoint. In September 2022, Bank of America put ESS shares on a list of stocks with above-market and safe dividends. The REIT is a dividend aristocrat that has delivered 28 consecutive years of dividend growth. Number 3. Stag Industrial, ticker, STAG. Market value, $6.1 billion. Dividend yield, 4.3%. Stag Industrial is a pure-play industrial warehouse REIT and a major beneficiary of e-commerce growth. Approximately 40% of its portfolio is e-commerce related. As a percentage of U.S. retail sales, e-commerce has grown from roughly 6% 7 years ago to 14.5% today, and e-commerce penetration is expected to hit 30% by 2030. Stag Industrial owns 563 warehouses in 41 states, with a total of 111,600,000 square feet of space to rent. Its tenants are primarily large, sophisticated public companies. Nearly 60% of the businesses that rent space there make more than $1 billion a year. While Amazon is Stag's single largest tenant, accounting for 3% of annual rents, the portfolio is well diversified both by geography and by tenant and lease terms. Its holdings span more than 60 markets and more than 45 industries. The REIT's cash flows are reliable, with less than 1/4 of its leases expiring through 2024. The $1 trillion U.S. industrial real estate market also provides Stag Industrial with plenty of growth opportunities. The REIT's acquisition pipeline is valued at $2.7 billion, but Stag is very selective in what it acquires. Last year, just 5% of the transactions in the REIT's pipeline met its due diligence standards and were acquired. During the September quarter, Stag grew core FFO per share by 7.5% and maintained a 98.2% portfolio occupancy rate. The REIT doesn't provide FFO guidance, but analysts' estimates look for 7% gains, on average, this year. Stag Industrial has delivered 3 consecutive quarters of FFO beats, suggesting analyst estimates may prove conservative. In addition to being one of the best REITs to buy, Stag is also one of the best monthly dividend stocks and has hiked payments every year since 2011. Stag shares are down a remarkable 30% year to date in 2022, trading at just 15 times FFO. Number 2. National Retail Properties, ticker, NNN. Market value, $8.3 billion. Dividend yield, 4.8%. Investors who want stocks with reliable dividend growth should think about buying shares of National Retail Properties, which has raised its dividends for 33 years in a row. This REIT invests in single-tenant, net-leased retail properties. It owns 3,349 properties with a total of 34.3 million square feet of space for rent. The value of its assets is $9.4 billion. National Retail Properties manages a well-diversified, recession-resistant portfolio consisting of convenience stores, automotive service locations, and full and limited service restaurants, such as Taco Bell, Wendy's, and Denny's. Its sites are leased to roughly 380 tenants nationwide. The REIT's leases provide reliable cash flow, secured by average remaining lease terms of 10.4 years. Additionally, NNN's portfolio has a 99.4% occupancy rate. National Retail Properties also offers an investment-grade balance sheet, no significant debt maturities before 2024, and great liquidity with over $1 billion of borrowing capacity available. The dividend payout is maintained at a conservative 67% of adjusted funds for operation or FFO. It's not only reliable dividends that make NNN one of the best REITs to buy in 2023. National Retail Properties has generated respectable 4.3% annual gains in core FFO since 2016 and annual shareholder returns averaging 11.5% over 30 years. The REIT's September quarter results beat consensus analyst estimates, with core FFO per share up 9.9%. National Retail Properties also showed commitment to growth by hiking its full-year FFO guidance for the fourth time this year. Acquisitions and high occupancy and rent collection performances bolstered financial results. NNN shares appear reasonably priced, trading at 14 times forward-adjusted FFO, a nearly 6% discount to similar real estate stocks. Number 1. W.P. Carey, ticker, WPC. Market value, $16.8 billion. Dividend yield, 5.3%. With an enterprise value of approximately $22 billion, W.P. Carey ranks as one of the world's largest net lease REITs. WPC invests in single-tenant, net lease industrial, warehouse, office, retail and self-storage properties that have long-term net leases and built-in rent escalators. The REIT's assets are located in the US and Europe. At present, W.P. Carey's portfolio consists of 1,428 properties leased to 391 tenants, encompassing 174.9 million square feet of leasing space. The portfolio breakdown by property type is dominated by industrial, 26%, and warehouse, 24%, with smaller concentrations of office, 18%, retail, 16%, and self-storage, 5%. Top tenants include U-Haul, the Spanish government, German retailer Hellweg and Extra Space Storage. WPC's portfolio has a weighted average remaining lease term of 10.9 years and a 98.9% occupancy rate. Approximately 55% of the REIT's leases have contractual rent escalators linked to CPI and another 40% of leases have fixed escalators. Helped by 5 consecutive quarters of same-store rent growth, W.P. Carey delivered 9.7% FFO per share gains during the September quarter and increased full-year FFO guidance. After closing an acquisition that adds over $2 billion of new self-storage real estate assets, the REIT ended the September quarter with $2.2 billion of liquidity and a rating upgrade by Moody's. W.P. Carey is another of the best REITs to buy for reliable dividend growth. Since going public in 1998, the company's dividend has gone up every year. Since becoming a REIT in 2012, the dividend has stayed the same. The payout from adjusted FFO currently ranges around 80%. WPC is currently valued at roughly 15 times forward-adjusted FFO, a slight discount to its industry peers. Plus, its dividend yield of 5.4% is well above the median REIT yield of 4.7%. This concludes our list of the 9 best REIT stocks to buy and hold now for dividend growth. Before putting your hard-earned money into buying stocks or investing in the market, you should always do your due diligence and research. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.